Joining us now is Brent Thill. He's an analyst with Jefferies. Thank you so much for being here with us, Brent. I understand that you've added Amazon to your franchise picks list while removing Google. Amazon, though, has kind of just traded sideways and hasn't made a lot of headway. So why are you so bullish on Amazon from here?
Yeah, I think, Courtney, to your point, Amazon has underperformed. Google has had a massive outperformance on a year-to-date and in one-year basis. We continue to believe in the sum of the parts for Amazon being north of $4,200 a share. And if you look at, while e-commerce will slow, and there's no question that we're going back to stores to buy, and e-com will have tough comps, the software and ad business are re-accelerating and are in a fantastic position. AWS owns 60% market share of the mega clouds, with Microsoft at 30 and Google at 10. And when you look at all the private companies that we work with as a firm, they're all going to AWS. And these are 10-year contracts that they're staying on the platform. And given the 40 to 50+% bookings growth in AWS, you're going to continue to see really good numbers, 30% plus growth, really high margin business. So while the lower margin businesses have tough comps in e-com, the high margin businesses like advertising and software are inflecting and accelerating. So we like that dynamic at Amazon. We like that Jassy, who is a software guy, is in charge. And we think ultimately that means higher margins over time.
And you just went through three of Amazon's big businesses, though certainly not the only silos. You can parse out many more, but e-commerce, AWS, and advertising. And then you have potential regulation coming down the pipeline, or at least more scrutiny out of Washington, D.C. Do you not see that as a threat to a company like Amazon?
Definitely a threat, but every time it's a threat, you buy the stock. We've been covering tech for 25 years, and anytime Microsoft had an overhang with the EU investigation, $30 stock obviously had a huge move from that point. So our call has been buy the regulatory fear, respect it, but buy the fear for investors. We do not believe that there'll be a breakup. And if I'm wrong, investors will benefit even more because the sum of the parts will yield incredible upside. And that's how we value Amazon. We don't value it on a whole. We look at each parts of the business, apply an individual multiple. And if they broke up, the other parts of the business, let's say they spun off AWS, this would be one of the largest market caps in tech just on its own for AWS. So again, I think any way you slice it, it feels like they're in a good position.
Brian, when in the back of a Fed meeting week, when you're doing your price targets for all of your picks in the tech sector, how closely are you factoring in what yields are doing, what interest rates are doing in terms of the discount rate you use? Or is that not really a factor unless we were up to 3-4%?
Well, if it's an important point, I'd say on our tech desk, Jared Weisfeld and Mike Toomey, who run our tech desk, have said that we are seeing material buying on our desk because of rates not moving in a big way, and that we think that there's effectively a short-term ceiling. That's pushed money back into tech, pushed money back into software, higher multiple names. You've seen names like Asana go absolutely vertical for other reasons as well, including insider buying, but you've seen growth coming back. So it factors into our overall recommendations as a firm. As the fundamental analysts, it doesn't factor in as much. It's certainly one of many things that factor in, but I just say from a tech flow, our tech desk is seeing for the first time a lot of our clients are really stepping back into growth. And you saw it today in a lot of the growth software names on our desk.
Shepard Smith here. Thanks for watching CNBC on YouTube.